Warren Buffett has owned this stock since 1988. He's never sold a share. His position today is over 400 million shares, worth roughly $33 billion at current prices. The dividend it pays him? North of $800 million a year. The stock is Coca-Cola. Coke. 64 years of consecutive raises. The Main Street test verdict? Pass, 4 out of 4 rules. But one number on this scorecard deserves a harder look: the cover ratio. It clears the threshold, just not by the mile you'd expect from a 64-year aristocrat. Hold that thought. Let me walk each rule. Quick disclaimer first. This is not investment advice, and it's not tax advice for your situation. Talk to a qualified accountant or financial advisor before you buy anything. The test I'm about to walk you through is the one I use for my own portfolio. On the record, every position. So what is Coca-Cola actually selling? Most people picture a red can on a shelf. They're picturing the wrong thing. The Coca-Cola company sells syrup, not bottled drinks. Concentrate. The actual canning, bottling, trucking, and shelving is done by independent franchisees that license the brand. Coke collects a royalty on every can. Why does that matter for a dividend investor? Because it's a capital-light business. Coke doesn't own the factories that bottle the drinks. They don't own the trucks. They don't pay the rent on the shelf space. All they own is the brand, the recipe, and the contract terms. That's why a company with a 64% payout ratio can survive 64 years of dividend raises. There's almost no capex eating the cash flow. Coke sells into nearly 200 countries. Roughly 70% of revenue is international. 3 Cokes outside America for everyone sold inside it. Currency moves matter. Recessions in any one region don't. And then there's Buffett. Berkshire Hathaway has held this position since the '88 crash, never reduced it, never trimmed it. The annual dividend Berkshire collects from Coke alone is bigger than the entire profit of most S&P 500 companies. Now, does the math actually pass? Let me show you each rule. Rule 1. The streak. 10 consecutive years of raises minimum. Coke's streak? 64 years. 6 times the minimum. Comfortably inside the dividend king category, 50 years plus of consecutive raises, which only 25 US-listed companies have ever cleared. But there's a wrinkle in the streak. Look at the recent raise sizes. 2024, 5.4%. 2025, 5.2. 2026, 3.9. The raises are slowing. Now, 3.9 is still a raise. Rule 1 only asks, did the company raise the dividend this year? The answer for 2026 is yes. Pass? The shape of that trajectory, mine on 5.4, 5.2, 3.9, is the watch point I'll come back to in the honest red. The streak is intact. The size of the raise is the conversation. Rule 1 verdict. Pass, 6 times the minimum. Next rule. This is the one I flagged at the open. Rule 2, the cover. The company must earn at least 1.3 times what it pays out in dividends. Coke's cover today, 1.54 times. That's a pass. It's above the 1.3 minimum, but it's the tightest part of this scorecard and it deserves the most airtime. Why does the margin matter? Because a tighter cover means less room before an earnings dip starts squeezing the dividend. Coke has enough cushion. But cushion isn't infinite. If Coke's earnings drop 15% in a single year, and most companies do in some year, the cover ratio falls toward 1.1, still above the cut line. But the board will be having uncomfortable conversations about it. The good news, Coke's payout has been ratcheting down over the last decade as buybacks have eaten the share count. The company earned $1.53 per share last year and paid out $2.04 in dividends. Sounds inverted, I know. It isn't. On a free cash flow basis, the number that actually matters for a syrup business, the payout's closer to 70%. There's no capex eating the difference. Rule 2, verdict, pass. Comfortable but not generous. Flag it on your watch list, don't panic about it. Halfway through the test, mid-roll, quick one. If you're a Roth IRA investor like me building a long-term dividend portfolio from scratch, the Main Street test is the framework I apply to every stock I buy. Hit subscribe. New deep dive every Sunday. Same 4 rules, different ticker, every week. The receipt prints either way. You get to compare them. Rule 3. The yield band, 2 to 7%. Coke's yield today, 2.6%. Comfortably inside the band, mid-range, clear of both edges. The S&P 500 today yields about 1.3%. Coke doubles that. If Coke raises its dividend 3.9% a year, the rate we just saw, your 2.6 starting yield becomes 3.2% in 5 years on your original cost basis. If the raises stay closer to the historic 5%, it's 3.3. Either way, you're well ahead of what the index pays. Rule 3 verdict, pass, inside the band, not on the edge. One rule left. Rule 4, the discipline test. No cut in the last 5 years and no freeze in the last 3. Coke over the last decade, 10 raises, 0 freezes, 0 cuts. Compared to a name that didn't make it. A T&T froze in 2020, froze again in 2021, then the cut hit in 2022. Boeing froze, then cut, then suspended the dividend entirely. The pattern shows up consistently in the historical record. Almost every dividend cut is preceded by at least one freeze inside the Rule 4 window. Coke shows none of that. 10 of 10, 0 red marks. Coke Rule 4 verdict, pass. 4 rules clear, framework, pass. Before I stamp the receipt, here's the honest read on Coke. 3 things to put in the back of your mind. 1. The raises are slowing, and that's the leading indicator I won't ignore. 5.4, 5.2, 3.9. 3 years and the raise size has nearly halved. Every year's still a raise, so the streak holds. But the size of the raise is the tell. Companies that drift towards 0 on raises tend to freeze before they cut. A freeze breaks Rule 4. We're not there. We're watching. 2. The cover. 1.54 is inside the rule, but it's the tightest of the 4. A weak year doesn't break it. It narrows it. Less margin before the board has to choose between protecting the raise and protecting the balance sheet. Comfortable today. Worth a glance every earnings season. 3. The category itself. Cola consumption in developed markets has been in slow structural decline for over a decade. Health-conscious shifts. Younger demographics drinking less soda. Coke has offset it with water, sports drinks, coffee, and tea. But the headline product is swimming against a generational current. The 70% international revenue split is the buffer. It also means a strong dollar is a constant headwind on reported numbers. So why pass, not buying? Because every single one of those concerns is known and priced in. Coke isn't trading at a growth stock multiple. The dividend is being prioritized even as the raise size compresses. And a capital-light syrup and royalty business survives slower growth better than a capital-heavy one. The framework's right to pass, and I'm buying at today's price. What would make me reconsider? The flip trigger, the 2027 raise below 3%. First warning, below 1% or held flat, that's a freeze and Rule 4 breaks. The cover falls below 1.4 on a quarterly print, not second, or 2 consecutive quarters of revenue decline. Third, any one of those, we retest. The receipt. Streak, 64 years, pass. Cover, 1.54 times. Pass. Yield, 2.6%, pass. Discipline, 10 of 10, pass. 4 of 4. Coke passes the Main Street test. Honest read flagged. Flip triggers on the watch list. The framework's call today is pass, and that's what gets stamped. What I'm doing, I'm buying Coke this week. It earned its spot. Tiny in absolute terms, massive in concept. And so the snowball grows. That's the Main Street test on Coke. 4 rules, the verdict, the receipt. If you found this useful, hit subscribe. And tell me what stock to run through the test next. Drop a ticker in the comments. The test is the receipt.